Have you ever gotten into a trade and got stopped out one tick or one pip or maybe 10 cents away from your target? The reason that this is happening is because the information that you received thus far about where to take profits is wrong. If you're using previous pivots, if you're using indicators, this is all entirely wrong. Today, I'm going to teach you how to use market structure properly, how to identify efficient versus inefficient areas in the market where you can feel confidence in taking your positions off the table, because this is where institutions understand there's liquidity, and this is where they're taking their profits. And once you learn to align yourself with the institutions, you're gonna start making money more consistently. Let's get started. Before we get started, I just want to let everyone know that I am not a licensed financial advisor. The content shared on this channel is for educational and informational purposes only. So let's first talk about market structure. We know that we have uptrends that are making higher highs, higher lows, higher highs, and higher lows. Then we have downtrends making lower highs, lower lows, lower highs, lower lows, lower highs, etc. And then we have stagnant markets, consolidation periods where we're making a high, a low, higher high, maybe a lower high, another high, a low, higher high, lower low, and yada until it finally decides it wants to pick a direction. That's the basics to market structure. Let's now talk about efficient markets versus inefficient markets. And once I get done with this, you're really going to have a better understanding of how you position yourself with trades. So as discussed, if we know that this is an uptrend because it's making a high, a low, a higher low, higher high, and a higher low, we know we have a break of structure here, we have a break of structure here, we've seen that the market is coming down. We know that this is an uptrend. To identify whether or not the market is efficient versus inefficient, we need to dial into these key areas right here. And the same works for downtrends. If the market is going lower like this, and we know it's a downtrend, we need to focus in on these areas right here to see if the market is efficient. And when I'm done with this, we're gonna go to some charts and I'll show you some real life examples. In order for the markets to be efficient, when the market breaks structure here, we know that this area right here is going to offer a lot of demand, because at this point in time, we're typically going to see some type of consolidation period on a lower time frame. And then what we see from there is a big explosion move to the upside. And typically when this happens, you're going to see candles like this that are in this area here. And before this candle, you may see just a bunch of random candles. We'll say like this, and we'll say maybe we have one like this, and then maybe we have another one like this, and then we'll say we have a candle like this. And then from there, it explodes up. So we know that this area here is the consolidation period, then the market moved higher. And this is all within this range right here, before this big move. After this candle, what we want to pay attention to is the next formation of candles. Because if the next candle is, say, like this, what's happened here is it's left a gap between this candle and this candle here. This whole entire range is now inefficient, meaning that the market has left a gap between these candles here. And the reason this is important is because inefficient markets are like magnets that price wants to fill. And this is very important that you understand this concept, because if you do, you're going to look at charts in an entirely different way. If an inefficient market is an area where there are gaps that need to be filled, that would mean that an efficient market is a market where there are no gaps. So let's take this scenario here of this downtrend, and we'll say that price is now coming back up to retest this area here. And if we notice that within this here, we have a range like this before it broke down. If we see candles like this, for example, we'll just say this is a bearish candle I apologize about the coloring here, but I think we're getting the concept. And let's just say that this move right here was a candle that looked something like this. A huge bearish candle that slammed down with momentum. And let's say the next candle was a candle like this. This area right here with this kind of price action would be an efficient market. Why? Because we see that this candle here, the bottom of this candle, and then the top of this candle, they overlap. You see how the market came up here and it filled this void right here? That would mean that this area is now efficient. And markets like to go to inefficient areas because those are liquidity pools. That's where orders are at. So it's hunting for these areas all the time. And once we learn to identify them, we can then start to take advantage of these trades. So let's jump over some charts now and take a look at how this looks in real time. What we're looking at here is the 30-minute chart of micro futures MNQ. And what I want to draw your attention to is a couple of areas on the chart that offer great opportunities to trade if you can identify them. So the first thing that we want to understand is what is an inefficient area. An inefficient area on a chart is an area where you see a lot of momentum in areas that have not been filled, also called fair value gaps. So we can see that we have this low body indecision candle here followed by a lot of momentum. And you can see between this wick and this wick, we left a gap. This area right here is now going to be what's called inefficient. So that would mean that this area here, this consolidation period, would be demand. So what we would be looking for is a buy in this area up to our next supply area, which would be on the left-hand side. And if we look over here, what do we see here? We see a low body candle followed by large momentum. So when we saw this and we see a breaking structure right here, our bias could be then, okay, if it were to come back down and retest this demand zone, we would put a stop below the demand zone with a target potentially up to this area here. But as you can see, we just rallied through and we broke through and we filled it. Now, that doesn't necessarily mean that we just short off this level. There's a lot of other factors that we need to have into place. However, you can see the idea here of price wants to go between inefficient areas and to fill those gaps. And that's exactly what price did here. But let's draw our attention to this area here. We see that we filled this inefficient area right here with high momentum. And you can also notice that right here, we left a gap between the bottom of this candle and the high of this candle, creating another inefficient area. So we broke through this inefficient area here on strong momentum. We left an inefficient area, so we know that this is now demand. And if we know that, we can now start to say, okay, is this going to be a good opportunity to take this to the next supply area? So what we want to do from here is look left to see if we can identify any areas on the chart. So if we look left a little bit more, we can see that we have an area here, right? This gap here had not been filled, which it filled. We have an area here between the bottom of this candle and the high of this candle that needs to be filled, and it filled it here. So we have these areas here that need to be filled. And as you can see, once price hit this inefficient area, if we knew that we had these areas here, we could simply just put our entry here with a stop below this, and this would be a 3-to-1 trade. And you can see it hit the first level of inefficiency, it filled the next level of inefficiency, and then it kept rallying higher on the chart, quite a bit higher, as you can see. So there's just one example. Now let's look at another one. Now looking at ticker MYM, which is the Dow Jones Micro Futures 30-minute chart. So the first thing that we want to do is look for our inefficient areas. And we can clearly see that we had this area here, low body candle followed by a huge push down. And then we have this area here, low body candle followed by huge push up, leaving a gap on this one, and you can see we have a gap on this one. So now we have a narrative as to what is going on within the micro Dow Jones. So what we want to do then is start to position ourselves for a trade once things start to happen. If we saw this coming into this, we could ask ourselves, all right, is it a good opportunity then to short this when it comes to here back down to here? Because we know that there's orders that need to be filled on both sides. Now again, I'm not just saying because you see these areas that you just short it or you go long, you have to apply other context to it, but just for educational purposes, let's take a look at this and see how this plays out. The market rallies up, it filled this gap, and then it hit this inefficient area right here. So if we were to take a trade right here, put it above the liquidity pool up here, this being 3-to-1, you can see it literally came right back down, hit a 3-to-1, but we still know that we have liquidity down here that needs to be captured. However, a 3-to-1 trade is a good trade. So let's just keep scrolling over. You can see that if we put our stop right here, we would have been dinged out right here. But if, say, we had it a little bit higher, price eventually came right back down, filled this liquidity area before rallying back up. And that, my friends, is how you need to start looking at market structure. Instead of basing your theories off trend lines and indicators, you need to look at the market structure, look for these inefficient areas, and trade them, because that is where the money is going to be made. There you have it, guys. A quick video on market structure, inefficient versus efficient areas. Once you start to grasp this and can start to see this on charts, it's going to change your trading, because now instead of relying on indicators or pivots or all this other nonsense that they teach you out there, you're now going to be looking at the narrative of the story and understanding what is actually going on in the market, where's liquidity, where should I be looking to enter and exit my trades on confidence. Hopefully you enjoyed this video. If you did, be sure to drop me a like, comment, subscribe. Please be sure to hype this video, because I'm telling you the content here is valuable. You're not going to hear this on very many places, and the ones that do teach it, you know that those are the people that know how to trade, and they know how to trade profitably. If you need more clarity on this subject, drop me a comment down below. I'll be happy to help. That being said, see you in the next video.